On January 30th, 2026, at exactly 2:47 p.m. Eastern Time, something broke. Silver crashed 30% in a single trading session. Not over days, not over hours, minutes. Your screen showed $121 per ounce, then $98, then $76. If you owned silver futures, your broker called. They wanted more money, right now, or they'd close your position at whatever price the market offered, which wasn't much. This wasn't a normal crash. Normal crashes happen when sellers overwhelm buyers, when panic spreads, when news breaks. This crash happened because of a memo, a regulatory change so technical that most financial journalists missed it entirely. CME Group, the company that runs America's commodity exchanges, changed how margin requirements work for silver traders. They moved to a percentage-based system. Maintenance margins jumped to 15% for standard positions. If that sounds boring, it shouldn't. What they did was pull the financial rug out from under thousands of traders who thought they owned silver, and the timing tells you everything you need to know about who really controls the market. Let's rewind 3 weeks. Silver was climbing fast. It hit $121 per ounce in late January. Retail investors piled in. Online forums buzzed with speculation about a shortage. Physical dealers reported delays. Premiums on actual coins and bars kept rising. The narrative was simple. Silver was finally having its moment. But something else was happening that most people didn't see. In Shanghai and Dubai, physical silver was trading at massive premiums over the Western paper price, $20 over spot, sometimes more. If the ticker in New York said $100, buyers in Asia were paying $120 for actual metal. That's not supposed to happen. In a functional market, prices converge. If silver costs more in Shanghai than New York, traders buy in New York and sell in Shanghai until the gap closes. It's called arbitrage. It's how global markets work. Except the gap kept growing, because the silver most Americans think they own doesn't actually exist. Here's how the game works. When you buy silver through most brokers, you're not buying metal, you're buying a contract, a promise, a piece of paper that says you have the right to silver. The exchange keeps a small amount of physical silver in reserve, maybe 5%, maybe 10%. They figure most people will never ask for delivery. They'll just trade the paper back and forth, buy low, sell high, cash out. It's efficient, it's liquid, it works perfectly until everyone asks for their silver at once. And that's exactly what started happening in January 2026. China implemented new export controls on January 1st. Any silver exporter now had to produce at least 80 tons annually. That rule locked out hundreds of smaller refiners overnight. Chinese buyers who relied on those suppliers suddenly needed new sources, fast. They turned to the global market. But here's the problem. The paper to physical ratio for silver sits near 356 to 1. For every 1 ounce of actual silver that exists in vaults, there are 356 ounces worth of paper claims circulating in global markets. Do the math. If even 1% of paper holders demand delivery, the system collapses. The exchanges knew this, the big banks knew this, and on January 30th, they decided to solve the problem the same way they solved it in 1980. They changed the rules.
The Hunt brothers crashed silver in 1980 by trying to corner the market. They bought so much physical silver that the price spiked from $6 to $50 per ounce a year. Regulators responded by raising margin requirements. Suddenly, the Hunts couldn't finance their positions. They had to sell. The price collapsed. History calls it market manipulation, a cautionary tale about greed. But January 30th, 2026 wasn't about stopping manipulation. It was about protecting the 8 banks that control the paper silver market from having to deliver metal they've sold 300 times over. CME Group announced the margin change during Asian trading hours. By the time American retail investors woke up, the crash was already underway. Automated systems triggered margin calls, brokers liquidated positions, the sell orders cascaded. Your silver position, the one you bought at $110, got closed at $82. You lost 25% of your investment in the time it takes to make coffee. But here's what they don't tell you. While paper silver crashed, physical premiums exploded. In Shanghai, dealers were paying $20 above Western spot prices. In Dubai, premiums hit 80%. Some physical transactions reached $130 per ounce, while your screen showed 76. Two prices, one metal. The market had split in half. Now let's talk about what this means for your money. If you own silver through an ETF, a brokerage account, or a futures contract, you own a claim on silver, not silver itself, and that claim is only as good as the counterparty's ability to deliver. When premiums on physical metal trade 20, 40, 80% above paper prices, the market is screaming something obvious. The paper is fiction. Real silver trades in Shanghai at $130. Your account shows 76. That $54 gap is the cost of the lie. And it's not just silver. 1-month lease rates exploded to around 8% by January 2026. That's the interest rate someone pays to borrow physical silver, 8% for a month. Why would anyone pay 8% to borrow silver? Because they sold silver they didn't have. Now someone wants delivery. They need actual metal to cover the contract, fast. Lease rates are the market's panic signal. 8% says someone is desperate, multiple parties are desperate, and there isn't enough physical silver to go around.
But wait, didn't the crash prove that silver was overvalued? Doesn't a 30% drop mean the rally was fake? That's what the financial media wants you to believe. Here's what they're not telling you. Fresnillo, the world's largest silver miner, cut production guidance on January 28th, 2 days before the crash. They dropped their 2026 forecast from 45 to 51 million ounces down to 42 to 46.5 million ounces. The CEO blamed operational phasing and narrower, lower-grade veins. Translation: they're running out of easy silver to mine. Production is falling, physical demand is rising, the paper market just imploded, and premiums on actual metal are at record highs. Does that sound like silver is overvalued? Or does it sound like the system can't deliver what it promised? Let's zoom out. The dollar index rose about 0.8% on January 30th, less than 1%. That's a normal daily fluctuation. A less than 1% dollar move should not cause a 33% crash in any commodity, ever, unless the market was already broken. The margin increase was the excuse. The real problem is structural. There are 356 paper claims for every ounce of physical silver. Banks sold promises they can't keep. Exchanges facilitated those sales. Regulators looked the other way, until the Chinese export controls exposed the scam. Now the market has split. Paper silver trades in New York and London at one price. Physical silver trades in Shanghai and Dubai at another. The gap between them is the lie made visible. And here's the uncomfortable part. This isn't about silver. It's about what happens when financial markets become disconnected from physical reality, when prices are set by contracts instead of supply and demand, when intermediaries sell the same asset hundreds of times to different buyers and hope no one notices. Silver is just the canary in the coal mine. You need to understand who benefits from this system. The 8 banks that dominate precious metals trading make money on volume. Every contract traded generates fees. Whether the silver exists or not is irrelevant. They're selling liquidity, not metal. The exchanges make money the same way. More contracts mean more fees. CME Group doesn't care if the underlying commodity is scarce. They care about transaction volume. Regulators are supposed to prevent this, but regulators are appointed by politicians. Politicians are funded by banks. Banks want liquidity, not accountability. So when the system breaks, regulators don't fix the problem. They protect the banks. That's what the margin increase was. Protection. Not for you, for them. Kevin Warsh was nominated for Fed chair by President Trump in late January 2026. Trump praised him in a statement saying he would go down as one of the great Fed chairmen, maybe the best. And, quote, on top of everything else, he is central casting. Central casting. That's a phrase from Hollywood. It means someone looks the part, plays the role, fits the image. Warsh looks like a Fed chair. Elite credentials, Wall Street experience, the right haircut. But here's what Trump didn't mention. He's also said publicly that the Fed has done a very good job of blaming others for their mistakes. That quote aged poorly. The Fed's policy created the conditions for this crisis.
Years of low interest rates inflated asset bubbles. Quantitative easing flooded the system with liquidity. Banks used that cheap money to build massive derivative positions in commodities. Now the bubble is popping, and the Fed chair nominee blamed the Fed for blaming others. The irony is almost funny. Almost.
So what do you do with this information? If you own paper silver, you need to ask yourself one question. Do you trust the counterparty to deliver? If the answer is no, you have two options: sell and take the loss, or demand physical delivery and see what happens. If you want exposure to silver, buy physical coins or bars from a reputable dealer. Store them yourself or in allocated storage where the metal is segregated in your name. Not pooled, not unallocated. Your serial numbers, your metal. It costs more, premiums are high, but at least you own something real. The paper market is a casino now. The house controls the odds, and when they don't like the bets, they change the rules mid-game. That's not speculation. That's what happened on January 30th, 2026. The broader point is this: markets are supposed to reflect reality. Prices are supposed to balance supply and demand. When markets and reality diverge, someone is lying. In January 2026, the lie became obvious. Silver trades at two prices, one for paper, one for metal. The gap between them is $54 per ounce. That gap is the cost of a system built on promises no one can keep. And silver isn't unique. The same dynamic exists in other markets, other commodities, other assets. Whenever paper claims exceed physical supply by orders of magnitude, the system is fragile, one shock away from collapse. China's export controls were that shock for silver. What's the shock for everything else? The crash was 3 days ago. The financial media has already moved on. They're talking about jobs reports, earnings season, and whatever scandal is trending. But the silver market is still broken. Physical premiums are still elevated. Lease rates are still high. The paper-to-physical ratio hasn't changed. Nothing is fixed. They just papered over the problem. Again. And that's the real story. Not that silver crashed, but that the system couldn't handle the crash without changing the rules. Because if they have to change the rules for silver, what happens when the same problem hits gold, or oil, or treasury bonds? At some point, you run out of margins to adjust. You run out of people willing to believe the paper. And then the divergence between price and reality stops being a glitch. It becomes a crisis. But if you think this silver crash exposed a crack in the financial system, wait until you see what's happening in the housing market. Because the same people who told you paper silver was as good as physical are telling you real estate is still a safe investment. And the math there is even worse.